By the late 1920s, the American stock market had turned into a national obsession. Ordinary citizens, factory workers, shopkeepers, teachers were buying stocks with the belief that prices could only go up. The New York Stock Exchange wasn't just a financial institution anymore. It was the symbol of the American dream itself. What made this period especially dangerous was how people were buying stocks. Instead of paying full price, many investors used margin buying, meaning they borrowed most of the money to purchase shares. Sometimes, people paid only 10% upfront and borrowed the remaining 90%. As long as stock prices kept rising, this system looked brilliant. When prices went up, profits multiplied. But no one wanted to talk about what would happen if prices fell. At the same time, the economy underneath the stock market was far weaker than it appeared. Industrial production had started to slow, farmers were struggling with low crop prices, and income inequality was growing rapidly. A small percentage of Americans controlled most of the wealth, while the majority had limited purchasing power. This imbalance quietly weakened the foundation of the economy. Banks played a risky role as well. Many banks invested their customers' deposits directly into the stock market. There were few regulations, no deposit insurance, and almost no safety nets. If the market fell, banks would fall with it, and so would people's savings. Still, warnings from economists were ignored, drowned out by headlines celebrating record-breaking market highs. In early September 1929, the market reached its peak. Stock prices were wildly inflated beyond the real value of companies. Some investors sensed danger and began selling quietly. This triggered small drops, then nervous reactions, and finally widespread fear. Once confidence cracked, it shattered fast. On October 24, 1929, later known as Black Thursday, panic erupted. Millions of shares were dumped onto the market as investors rushed to sell before prices collapsed further. Stock tickers fell behind by hours, unable to keep up with the volume of trades. People stood outside brokerage offices, staring at screens, realizing they were losing fortunes they never truly had. Major banks and financial institutions stepped in temporarily, buying large blocks of stock to stabilize prices. For a moment, it worked. The market steadied, and some believed the worst was over. Newspapers tried to calm the public, insisting the fundamentals of the economy were still strong. But the fear never left. It only waited. Just days later, on October 28th and 29th, the market collapsed completely. Black Monday and Black Tuesday erased billions of dollars in value. Prices fell faster than anyone could react. Margin calls flooded in, forcing investors to sell at devastating losses. Dreams of wealth vanished in hours. Lifelong savings were wiped out in minutes. By the end of that week, the illusion of endless growth was gone. The stock market crash didn't just destroy numbers on paper, it destroyed trust. Trust in banks, trust in institutions, trust in the future. And this collapse was only the beginning of a much larger disaster that would reshape America for an entire decade. Once the stock market collapsed, the damage spread far beyond Wall Street. What had started as a financial disaster quickly turned into a full-scale economic collapse. Banks were the first to feel the shock. As stock prices crashed, banks that had invested depositors' money lost massive amounts overnight. People, already terrified by market news, rushed to withdraw their savings. This sudden surge of withdrawals triggered bank runs, where banks simply did not have enough cash to give everyone their money back. One by one, banks shut their doors, taking people's life savings with them. With banks failing, credit disappeared almost instantly. Businesses that relied on loans to operate could no longer borrow money. Factories slowed production or shut down entirely. Small businesses collapsed first, followed by larger corporations. As companies failed, millions of workers lost their jobs. Unemployment skyrocketed across the United States, leaving families without income and without security. As people lost jobs, they stopped spending. This drop in consumer demand created a vicious cycle. When people didn't buy goods, businesses made less money. When businesses made less money, they laid off more workers. Each wave of layoffs caused even less spending, pushing the economy deeper into crisis. The stock market crash had exposed how fragile the economic system really was. Farmers were hit especially hard. Crop prices fell sharply because people could not afford to buy food at normal prices. Many farmers already carried heavy debt, and with falling income, they could no longer repay loans. Banks seized farms, forcing families off land they had worked for generations. Rural America sank into extreme poverty, often forgotten as cities struggled with their own disasters. By the early 1930s, the United States was fully trapped in what became known as the Great Depression. Bread lines stretched across city blocks. Families lived in makeshift shelters built from scrap wood and metal, later called shantytowns. Hunger became common, and basic survival replaced ambition and dreams. For many Americans, the idea of economic security felt permanently broken. The psychological impact was just as devastating as the financial one. Trust in banks, the stock market, and even the government collapsed. Many people swore never to invest again. The belief that hard work alone guaranteed success was shattered. Fear replaced optimism, and caution replaced risk-taking. This shift in mindset slowed recovery and haunted the economy for years. The government initially struggled to respond. At first, leaders believed the economy would correct itself naturally. That belief proved disastrously wrong. As conditions worsened, it became clear that massive intervention was unavoidable. This realization marked a turning point in American economic policy. The federal government began taking responsibility for stabilizing the economy in ways it never had before. New laws and reforms followed. Banking regulations were introduced to prevent reckless speculation. Deposit insurance was created to protect people's savings and restore trust in banks. Stock market oversight increased to reduce fraud and excessive risk-taking. These reforms permanently changed how financial markets operated in the United States. The crash also reshaped how Americans understood risk, wealth, and responsibility. It proved that unregulated markets could destroy entire economies, and that collective confidence could vanish faster than it was built. The lessons learned from the first stock market crash influenced every future financial policy, from later recessions to modern market safeguards. Even decades later, the memory of the first stock market crash remains powerful. It stands as a warning about greed, unchecked speculation, and the danger of believing that growth is guaranteed forever. What happened in 1929 was not just a market failure. It was a human tragedy that redefined the relationship between money, government, and society in America. If this story changed the way you look at the stock market, don't let it end here. The past still controls the present more than most people realize. Hit subscribe if you want more real stories behind money, markets, and moments that reshaped history, stories they never taught clearly in school. And if this video helped you understand even one thing better, tap the like button. Let's take this video to 10,000 likes so more people can learn what really happens when markets collapse and confidence disappears. Your support keeps this channel alive and the lessons alive.